Video here of a discussion between two monetary economists. One is Larry White, who obviously is talking in favor of the gold standard, and then Scott Sumner, who's talking in favor of fiat currencies. Scott Sumner was not really the pioneer, I guess the modern pioneer of nominal GDP targeting, which is a rule for the Federal Reserve. Instead of targeting the rate of inflation, they target the rate of total spending in the economy, so GDP plus inflation. When we talk about monetary rules later on in the semester for monetary policy, we'll talk a lot about nominal GDP targeting and Scott Sumner's idea. He was, now I don't remember who put it out, but it did a ranking of like the most influential people. And at one point during the recession, like 2009, I think, he was like tied for number like 8 or 9 with Ben Bernanke, because of his ideas on monetary policy. And you're starting to see it actually impact the Federal Reserve. A few of the governors, maybe like 2 or 3 people on the board have actually spoken positively about nominal GDP targeting, which is a pretty big deal because it switches up the Fed's operating system. And they've been doing inflation targeting since like the early 90s.
With the onset of the financial crisis and the Great Recession, a lot of people have been re-examining our monetary system. There was a lot of criticism of the Federal Reserve's role in particular. A lot of people feel that the Federal Reserve printed too much fiat money and they have too much discretion over the monetary system. They prefer a return to something like the gold standard of the 19th century. At the same time, most economists, including myself, are somewhat skeptical of the gold standard for reasons having to do with the Great Depression. So Larry, why has gold gotten a bad rap?
It's gotten a bad rap because people think the Great Depression was the result of the gold standard, whereas in fact it's the result of central bank mismanagement of a system that was partly gold standard, partly central bank discretion in the interwar period. If you go back to the classical gold standard, before there were central banks in the US and Canada and other countries, or the central banks that existed were more playing by the rules of the game, you don't have an event like the Great Depression. The classical gold standard was characterized by periods of mild inflation, followed by periods of mild deflation, and really a pretty steady price level over the long horizon.
Let's take that example. So I agree there was government meddling during that period, but fundamentally the problem in the Great Depression was a big global increase in the demand for gold. Why is that bad? Because under gold standard, the nominal price of gold is fixed. So when there's more demand for gold, its real value can only rise by the price of everything else falling. And when you have a lot of deflation, you tend to get high unemployment. Even if that was a mishandled gold standard, the thing I worry about is if we return to the gold standard, there could be some global shock that creates a big increase in demand for gold, such as a boom in Asia, and that could be deflationary for the world economy.
Well, as you know, the big increase in the demand for gold during the Great Depression came from central banks. It didn't come from the private economy. And if we go to the historical record and ask how big were demand shocks for gold under the classical gold standard, they weren't that big. The biggest example I know of was Germany decides to join the gold standard, so they're buying a lot of gold in order to make gold coins. And it has a very minor effect. One that's easily accommodated. It doesn't cause any Great Depression.
Just as there was sort of a good and bad period for the gold standard, you could say in the fiat money there was kind of a bad period that was the 60s through the early 80s with really high inflation. But then central banks switched to targeting inflation, and basically inflation's been pretty close to 2% in recent years. So much of the pressure to return to the gold standard is to prevent this really high inflation. It's an anchor for the price level. But couldn't you say that we've sort of solved the problem of high inflation with our more recent fiat money system, and that takes the pressure off returning to the gold standard?
So the case for a gold standard is not just that the average inflation rate would be lower. It's also that the price level would be more predictable, right? Because there's commitment and because there's a equilibrating mechanism in the gold mining industry to bring the price level back to a predictable path. You find errors in predicting the future price level, this is kind of a subtle point, were smaller under the gold standard. You could rely on where the price level was going to be 10, 20, 30 years from now, whereas today, there's a huge amount of drift.
Admitted.
So if you look at financial markets, you found 50-year bonds being issued under the gold standard. You found 100-year bonds being issued. The British government refinanced its debt with perpetual bonds. There is no market for 100-year bonds, perpetual bonds nowadays, because nobody knows what the dollar is going to be worth when it's paid back 50 years from now. So having that kind of a credible anchor makes the financial system deeper. And it's hard to quantify how big a benefit that is, but it means more long-term planning, more long-term investment by lowering the cost of making those kind of commitments with nominal contracts.
I guess in the end, I feel that even a well-run gold standard, which I think did a good job for people in the 19th century overall, falls short of a well-run fiat money system. So I really think that the argument that I think...
Have we had a well-run fiat money system that you can point to?
I think that it was pretty well run from the mid-'80s to the mid-2000s, about 20-year period. Admittedly, that's a fairly short period, but in terms of inflation alone, I think the monetary system has been pretty well run since the mid-'80s. Now, the Great Recession is sort of a black mark on the Federal Reserve in my view, but not because inflation got out of control. Rather, I think they had the wrong target. They should have been targeting nominal GDP rather than inflation. So I see this as a process of gradually learning. We did very poorly in the 70s. We adopted an inflation target that did much better in the 80s and 90s. And the next iteration will be even improving on that to avoid the sorts of mistakes we made in the Great Recession. So I think there is a trajectory here where we are hopefully learning from our mistakes. And going back to gold, I don't think there's any sort of a shortcut to getting to the right system. If we can't really get fiat money right, I don't trust the government to run the gold standard in the correct way.
So we need to pull back a little and distinguish different kinds of fiat systems and different kinds of gold standard systems. If you have a monetary policy rule fastened on a central bank, and you're asking why can't that work just as well as the gold standard, you still have a central bank. You still have the camel's nose under the tent, and the central bank is going to do, experience tells us, everything it can do to loosen the constraints on itself. This is a point Milton Friedman made in a lecture back in the 80s. It's not in their interest to just be the Bureau of Weights and Measures and to just follow some routine. They really think that they can improve matters by timely intervention, and they're always going to be looking for ways to do that. The genius of the gold standard is that it doesn't require a central bank. So you're right, fastening a gold standard on a central bank is just one rule among many we could fasten on a central bank. But you can have a gold standard without a central bank. You can have a gold standard with free banking, meaning you decentralize the issue of money. And then there's nobody who's in a position to intervene. There's nobody in a position to make the huge kind of mistakes that central banks make, either overexpanding or overcontracting the supply of money. You have a more self-correcting system where you diversified the risks of money supply errors.
Here's my concern. I think that if you sort of postulated the sort of political commitment that we would need to not only go back to the gold standard, but to do it right, if we really had that much willpower in our political system, we could also do fiat money right. Fiat money has some advantages that gold doesn't have, the ability to offset changes in demand for money more flexibly.
On the question of velocity shocks, if you have a free banking system, an increase in the demand to hold money is something that banks will be happy to satisfy. It's in their profit motive interest to issue more claims on gold when people want to hold more money. And so that problem solves itself. You don't have to rely on a central bank being alert to what's happening to velocity, as the Fed was not.
Think of the challenge of setting that up. I think you'll agree that to really make the gold standard work, you need international cooperation, because if only one country adopts the gold standard, its exchange rate will move up and down with the price of gold.
Having an international conference as a way of getting back to a gold standard is, far off in the future, because the political will is certainly not there now. That's one way to do it. Another way to do it is have a large country like the United States or the Eurozone decide that that's what they want to do, and then trying to persuade the other major central banks, the ECB, the Bank of Japan. That would be enough, just those three central banks. But my concern is not so much with the transition path, but with people understanding how well the gold standard worked and how it provides at least a benchmark for what we should expect from the Federal Reserve System.
I agree partly with that in the sense that you should demand a rule in our monetary system. The gold standard was a rule. It perhaps was better than some of the alternatives in the 19th century. But I would say we've learned enough that we can do a fiat money rule better than we can set up a gold standard rule.
On a blackboard, we can.
Right. But I think also in reality, because
I don't think there's a fiat money system that has a track record.
well, it's certainly true that any system, including fiat money system, could be messed up. And it's true that historically governments can and have occasionally done a poor job in running a fiat money system.
More than occasionally.
But I would say the same about gold. There's an ideal gold standard, but in our modern world, governments like to intervene, and I worry that they would intervene and mess up the gold standard as well. So ultimately, I think either system requires a certain amount of government restraint and intelligence.
It's a problem for any reform that can be proposed, that if the government's not going to live by the rules, then we've got a problem.
What do you think? To see previous episodes of Econ Duel, check out our playlist. Or, if you want to read more from Scott.
All right. That will bring us to the end of the gold standard stuff. Do you guys have any questions, lingering questions about the gold standard? Or the switch to the fiat currencies? It's always entertaining to see those two go at it because even though they seem to agree on a lot of stuff, they're both very passionate about the gold standard nominal GDP targeting. So they enjoy fighting with each other. So now I'll talk about alternative currencies. First talking about some of the ideas that came out in the 70s and then moving into the more modern ideas like cryptocurrencies. So first, Friedrich Hayek won the Nobel Prize in 1974 for his role in the social calculation debate and monetary economics. This was the year after Ludwig von Mises died, and because you can't award a Nobel Prize to someone who's passed away, it appears that the committee thought, oh boy, like one of these two super influential economists died. We have to give it to the other one right away to make sure that they're recognized for that. So they awarded him the Nobel Prize that year. Hayek had not been writing in economics for a couple decades. He'd mostly been writing political philosophy stuff. But suddenly he thought, oh, now people are paying attention to me again. So he developed this idea about private competing currencies. And he thought if the government got rid of the requirement that you had to pay taxes in the US dollars issued by the federal government, that we'd see a basket of competing private currencies. So you could choose among several different ones based on whatever quality attributes that you thought were more important. And he thought this system could function in the United States, having several different currencies, and not regional, but like literally competing against each other. So you could choose to spend US dollars or I don't know what one of the competitors when you went to Frankie's or went to the LPG, and prices would be denominated in all those. And he saw these as being privately issued, like we saw banks issuing money under the gold standard, but they would be irredeemable. So it'd be fiat currencies like we get from the US government. So just not even IOUs, just basically slips of paper saying how much it's worth. And he believed that the issuers that put out this money would promise a stable purchasing power. Obviously, you don't want currency that's going to fluctuate in value a lot. You want prices to stay the same. You want your salaries to stay the same. You don't have to worry about trying to calculate what the inflation rate is going to be for the future if you're thinking about saving up for a product or even just like saving for retirement. And then he saw like a vibrant financial press, like you see people watching stocks and very involved in what's going on with the companies. They would do the same thing for these currency issuers. You constantly have the prices being shown and the conversion. Yeah, whatever the conversion was between the different currencies, those would be constantly reported. Any currency falling below its par, its stated value would lose customers. If there was surprise inflation, you would see people get rid of that currency and go to an alternative currency, one of their competitors. And he believed that would be enough to force these issues of currencies to not inflate their currency. Obviously, they would be earning seniorage from the inflation, so if they would increase their issued money supply, they would spend it into circulation themselves. So so they actually get a profit from issuing new currency. So you've got those two things competing against each other. You need people to use your currency for it to be valuable. So you need a stable purchasing power of it, low inflation. But inflation is how you get profit. But he thought the need to have a stable purchasing power so that people would be willing to hold the currency would be enough to stop them from inflating their currency. So unlike the traditional free banking period, Hayek's regime relied on promises. There were no contracts. In the free banking period, where that occurred in places like Canada and Scotland, Sweden, the money was contractually guaranteed to give you a certain amount of gold for the bank, or a certain amount of silver. In his theoretical idea, there's it can't be redeemed for anything. Okay, so this isn't the most realistic system. It's never occurred in real life, so we can't look to a historical example and explain why it can't occur. One of the reasons that we doubt its viability is it's contrary to Mengerian convergence. You see, it's difficult to function with several different currencies and to constantly know the exchange rates between them. There's an idea called menu cost, where it costs money for a business to change their prices on the menu. It's like you go to a restaurant, they have to print up a brand new menu if they're going to raise their prices. If you have to denominate all your prices in several different currencies, that's going to be more expensive, to print up. It's going to be more of a hassle for the businesses dealing with it. And then if the exchange rates are changing between those currencies, they're going to have to constantly print new menus to try to change to keep it current. So it's going to be a hassle, and it's going to be an annoyance. And people are going to tend to use one currency. They're going to move towards the best one, like we talked about before. Another problem is what's called time inconsistency. So if the issuer currency makes a promise right now, they'll get more people. Say they make a promise to keep their purchasing power stable. More people are going to want to hold that currency then because they believe them. But once all those people start using that currency they issued, the bank then has the incentive to go back on that promise. That they'll make a lot more money if they inflate the currency and spend that into circulation. So sometimes the profitability of staying in business for these currency issuers may not outweigh the seniorage that they can get from issuing large sums of money. So they can hyperinflate the currency, spend all that in immediately, and then no one's going to use the currency after that. But in that meantime, from spending that money, that may be worth more than the present value of all the future money that they would make from managing that currency well for the future. So a couple researchers, Calvo and Ta, both showed using different models that the hyperinflation can be profit maximizing for an issue of fiat type money in Hayek's privately issued money if they hyperinflate fast enough. They do it over a couple of years. Obviously, people are going to abandon the currency early on, but if they can do it all at once or very quickly over a couple of weeks, they can make a greater profit than staying in business for the future. And these assume that the marginal cost is zero or very low for adding. He says for adding additional zeros, but for making the currency larger, that if the cost is low enough to actually do that, and it doesn't cost too much to actually print a dollar bill, then the hyperinflationary burst is profit maximizing. So obviously, if an issuer, someone rational, they're profit maximizing, they want to try to make as much money as possible. If they would want to hyperinflate their currency, if people understand this, then no one's going to hold that currency. If you don't trust that it's going to be worth anything next week or in a couple weeks, you're not going to want to hold that money. You're not going to want to use that money. So it's really difficult to imagine private fiat type currencies to get off the ground to actually first be issued and people accept it and use it, unless the issuer can somehow pre-commit to not hyperinflating. If they could somehow convince people that they're not going to inflate their currency and make it basically worthless, then people may be able to do it, or to adopt the money and to begin spending it. So they'll accept their salaries in this new money. They'll hold on to this new money and make purchases, maybe save in it. Now there's two ways that that privately issued currency can credibly pre-commit. The first is if they specify a path for the quantity of its issues at all future dates. So if they guarantee that at this point in the future there's going to be so many units out there, and then it'll grow at a certain pace, but they say it's going to be at this level, and give all the dates that it's going to be there. If they can pre-commit to that path and people believe it, I don't know, they somehow contract, like they, sign a contract saying that they're going to keep it at that path, and people believe it, then people may be willing to accept it and they can get off the ground. The other is commitment to a specified value in a redeemable contract. So if they say you can exchange this currency with us for this good or this basket of goods, but at that point you're no longer fiat currency anymore, you're going back to a commodity standard. So there's been some ideas in the past 30 or 40 years about redeeming for a basket of goods. So they say you can get, I don't know, they just pick some random things, whether it's like a bunch of precious metals or whether it's like actual like commodities that people normally buy and sell, tying it to a basket of those goods so that people can come in and redeem it, and so they can tie the money supply to those goods. However, at that point, you're just back to a commodity standard, and that's, once you're in a fiat system, the whole point is to not increase the resource costs of issuing currency. And once you specify a basket of goods to redeem it in, you're back to a commodity standard with higher resource costs. So like I said, there's no historical experience of these privately issued fiat currencies in existence, and especially not one with several competing against each other. It's very unlikely to believe that the time and consistency problems can be solved when no one's figured out a way to do it yet. Obviously, maybe there is some way to do it. As we'll talk about later, Bitcoin has, and the cryptocurrencies in general, have figured out, they have attempted to solve this problem, but time will tell if they actually will or not. So all private monies that have been issued, so again, this is not being issued by the government, but being issued by banks or by businesses. It's been full-bodied commodity monies, so literally gold, silver coins, things that have actual value, or redeemable monies. So you get slips of paper for that can be redeemed in commodity money, so like gold coins. Larry White has a picture there from a bank in Northern Ireland. They sell banks there that issue private currencies, but they're actually backed by the pound. So if you would get one of these privately issued bills from a bank in Ulster, you can redeem it for £5 with the British currency and use that to spend. So even though it's privately issued, it's still backed by a different fiat currency. He told a story where he went to a bank and actually tried to redeem it for £5, and they said something to the effect like, "We don't do that." And he said, "Well, it says right here on the bill, it's like a contract that you have to give it to me." And they said, "Oh, we have a branch a couple blocks down that has a bunch of pounds, so you had to run down there and get it." So I guess not too many people actually take advantage of that. So not too long after Hayek wrote that, at the same time, Ben Klein was working on trying to envision a privately issued fiat currency, and he believed that through a firm's what he called brand name capital, that could encourage firms to not hyperinflate their currency. Yeah, if consumers and producers make the same estimate of short-run profits from a policy of deception, then equilibrium quantity of brand name capital will ensure that firms will not excessively overissue. So firms worried about their reputation, worried about the consumer perception of their quality, that would be an additional cost of hyperinflating for them. So they're going to want to try to issue money with a stable purchasing power in order to maximize this brand name capital. And this is his idea that basically the competition will prevent hyperinflation from being profit maximizing for these private issuers. But there's a question of whether the value of preserving this brand name capital, if it's going to exceed the profit from hyperinflating. In his model, it didn't, but after this, several other economists looking at it, making different assumptions about the profit motive and about brand name capital, saw that their model suggested that brand name capital is not enough to overcome this desire to hyperinflate. So with perfect foresight, so individuals being able to look at the firm that's issuing the currency and seeing how likely they are to hyperinflate, when they have perfect foresight, all changes of the purchasing power of money is anticipated. Obviously, this isn't the real world, but under this assumption, then brand name capital is more than enough to prevent them from hyperinflating. Because in his idea, with perfect foresight, no one's going to be willing to hold currency if they think they're going to hyperinflate that currency, which obviously makes sense, but people aren't always perfect. They don't know exactly what's going on in the firms. So I'll skip some of these details. So under perfect foresight, if they expect a firm is going to hyperinflate the currency, or just have inflation in general, it's going to have to be compensated by an interest yield on that currency. So in order to convince them to hold it, they're going to have to be paid interest to deal with the inflation. Obviously, can you guys think of a problem with paying interest on currency? It's weird, right? Trying to think of that? Because you're holding paper bills. Like, how do you know who has it? Especially not in the 70s, but even now, there's no way to figure out who's got the bills on them to actually go and pay them the interest to actually compensate them. So, all this looks good on a blackboard. In real life, it's it's still impossible to figure out how to do this. So if they want to try to do this in practice, any newly printed printed currency had to be issued to the people that already hold the money proportionally to how much they hold. Difficult, right? If not impossible, really weird, not worth the hassle. So yeah, with perfect foresight, hyperinflation is not their dominant strategy. And the rate of inflation doesn't even matter because the money is being distributed to the issue or to the people that hold that currency. This is weird. It's not very realistic. Yeah, this goes directly against what other economists had said in the lead up and since then, who argue that this laissez-faire, this free market and money issue of fiat money will lead to an infinite price level. They're assuming people are going to counterfeit, like I gave that example from Somalia last week, that people just print up their own currency and spend it into circulation. They didn't look at, the other economists didn't look at brands of money, a way to distinguish between them. They just imagined like all these private issuers issuing like US dollars, like the same dollar. So it would be indistinguishable. So you don't know who, if you would counterfeit, you wouldn't really know which brand it came from. If this came into existence, if this was actually practiced, it would drive the value of the private fiat monies to near zero. So whatever it costs, like the paper and ink, basically, put on there. So yeah, so it'd be virtually worthless. But that's true for any good. If the quality is not easily detectable when you look at it, and there's no brand names to distinguish them, you can counterfeit it all the way down until it's basically worthless. So money is no different in that regard. But then Klein's perfect foresight assumption rules out the quality deception by virtue of his assumption. So that's the main problem with his model with the perfect foresight. He then adds an imperfect foresight, and I don't want to go through the details of this too much. This is just sort of to set up what cryptocurrencies are solving. I didn't get to delete all of these out of there last night. Basically, with his imperfect foresight, he believed that hyperinflation will not be profit maximizing if money growth sufficiently reduces consumer confidence and thereby sufficiently reduces the rental price the firm can earn on its money. So it still involves consumer confidence and consumers expecting what these private issuers are going to do. Basically, he says consumers are going to insist on a lower rental price, so on lower inflation to keep profit from rising with money growth. Basically, what he's doing is reintroducing perfect foresight through the back door. So the public under-anticipates the growth of the money supply. They under-anticipate what inflation is going to be, but they somehow know exactly how much they underestimate it by and expect that much money in like the interest they're being paid or the amount of currency they're getting from the new issue. So like if they know the discrepancy between the actual and anticipated, then they perfectly anticipate. So his model suffers from bringing in this assumption again through the back door, and that's the only way that he can get it to work. So the other people the other economists that show that this isn't practical and it couldn't work in the real world, don't obviously reintroduce perfect foresight. So basically what we see from Hayek and Klein is that despite the best world they can imagine, the time and consistency problem makes this type the privately issued currency infeasible. That it just will not be able to work if it's not backed by anything or it's not pre-committed to go on a certain path, the money supply. Without either one of those two guarantees, the profit maximizing thing for the firm to do is just to hyperinflate. They earn a large profit in that time, which is greater than the present value of the future stream of all their profits. Brand name capital, Klein's idea doesn't solve the problem, even though you would hope that firms would, in a free market, in order to profit, they would have to, offer a higher quality product. In this case, we see that's not true. The traditional approach to making private money trustworthy has been redeemability, and that's what we've seen so far. The issuer contractually pre-commits to buy back the money at a predetermined price. So you have that $1 bill, you take it into a bank, and you get $1 worth of gold. So we asked the question, can a quantity pre-commitment do the trick? And this question, I don't know, when it was asked back in like the 80s and 90s, a lot of people would doubt it and say no. But we've seen with cryptocurrencies, Bitcoin being the most common one, but there's plenty of other cryptocurrencies. They show that this is feasible, that they can credibly pre-commit to a trajectory of growth in their money supply. So just some basics about Bitcoin. This is privately issued. It's not issued by a company. It's what's called decentralized. So it's a bunch of individuals that are mining or creating Bitcoin, which is awarded for them validating transactions. Um, Basically, each Bitcoin is a unique digital string of characters, so it's got, I don't know, random numbers and letters. That's like its serial number. And there's a giant ledger called the blockchain, and all the transactions, anytime a Bitcoin goes from one person to another, it has to be verified. So they've got computers running. Some people do it just like around the clock. That somehow go through and verify each time a coin passes from one person to another to ensure there's no, I don't know, there's no double counting of coins, that the coin actually went from one person to another, instead of someone just like counterfeiting some into the money supply. Yeah, so it was first, well, what's called the white paper, the detailing exactly what Bitcoin is and how it operates. It was posted, I think, 2009 by Satoshi Nakamoto. No, it's not on there. I forget. It's a pseudonym that some guy came up. No one knows who the first actual person to come up with this Bitcoin is. There's some talk and there's some theories. They've narrowed it down to people think like 4 or 5 people that it could be that were like in on it early, but no one really knows for sure. John McAfee, who's super into Bitcoin, he was someone who he said was a pretender, like claimed to be Satoshi Nakamoto, and he was like doxing that person and like trying to show that it wasn't really him. McAfee's really out there, but it was just interesting. People are really, and myself included, interested to see who the actual like inventor of Bitcoin was, who came up with this. Like the privately issued currency for like Hayek and Klein, it's irredeemable. So you can't turn in your Bitcoin and get something of actual value. It's just another fiat currency. No other possible use for it, and it's entirely digital. So there's not even an actual coin or an actual certificate that you get. It's just you open up your wallet on the Coinbase or whatever app you use, and you swipe it. Like I said, very few places actually accept this currently. I know like a lot of the food trucks in DC would accept it. There was talk of some businesses accepting it when the price was spiking, but there's a lot less interest in it now that the price dropped by like 30 or 40% since then. Now this has some substantial differences from Hayek and Klein's model. There's no opportunistic issuer. There's no firm or one person that's putting out the Bitcoins and that's able to profit from the seigniorage of issuing the currency. It's completely decentralized. And the new coins are generated at a pre-programmed rate through this mining. So like I said, like you have the computers validating the transactions. Every time you validate a transaction, or I guess a certain number, you're then awarded a Bitcoin for that. And when it started out, it was like you validate one transaction, you get like 12 Bitcoins. And then it's slowly decreasing, and now you have to validate a ton of transactions before you get one. I remember when it first came out, or was generally new. I think I first heard of it in like 2011 maybe, or 2012. I thought about buying a few, I'm like, oh, the price will probably go up. And one of my buddies actually did. He bought several and he started mining. So he ended up with a nice little chunk of change from that. Especially when it spiked to like 17,000 or 19,000 for a Bitcoin a couple of years ago. Bitcoin has a quantity pre-commitment that I mentioned is the other way to ensure a privately issued fiat currency can work. So there's going to be 21 million units when Bitcoin finally does max out their money supply. And that's going to be a long time in the future, but it's increasing increased substantially at first, and then it's like approaching 21 million units like an asymptote, so it's getting the increase is getting smaller and smaller and smaller. It's like virtually nothing until we get those last units. This is like 2 or 3 years old when the money supply was 12 million Bitcoins. I don't know what it's up to now, but it's much higher than that. And for a transaction to go through, so if I paid one of you guys Bitcoin for something, it has to be validated by 51% of the miners. By mining, I mean the validating the transaction. There has been concerns by people who look into Bitcoin about someone taking over the system. So if you somehow got 51% of the miners to collude together and I guess to lie to validate a transaction, you could like take over the system. Some people are concerned that I don't know, this level of protection isn't enough. So there's other competitors. I think it gives Litecoin as an advantage, or as one of them. They claim to have better safeguards. I don't know exactly what Litecoin's safeguards are, and it also has faster validation time. Bitcoin takes like 10 minutes, and Bitcoin split a couple years ago. So there's like Bitcoin like Classic, and then I don't know, new Bitcoin, maybe Bitcoin 2.0. I don't remember what they were fighting over, what they wanted to do. I think it's something to do with the validation, that they wanted to do a quicker and easier way to validate. There's a lot of other cryptocurrencies like currently in the market that are competing against each other. They have different characteristics. It's the same general idea of the pre-commitment to the money supply path, but there's some, might just be called green coin, but there's one that takes a lot less electricity to validate a transaction. There's Ethereum, which is claimed to have a much better blockchain. The state of Delaware like legalized it to be used in the payment process, I think 2 years ago now. And firms want to use it in their supply chain because it has what they call smart contracts. Like these contracts that basically write themselves and automatically like go into place. So it makes managing your supply chain, so buying from suppliers and then selling, selling to a distributor, or getting to a distributor and then selling it out to whatever like retail place. It does these things automatically, so it's a lot cheaper for firms to do. The coin itself is like really no different than Bitcoin, but its blockchain is supposedly superior. And just a list of Bitcoin competitors. You can pull that up if you're interested on your own. Okay, I think we'll stop here. Yeah, class ends in like 5 minutes. Do you guys really feel like staying here the whole time?